All right. Good morning, good afternoon, everybody. This is Kurt Thompson, the managing partner of the firm. I'm going to start by providing kind of a brief firm update, and then I'm going to turn it over to Nick and Matt for the actual formal webcast review. The firm crossed the $1 billion asset management level in the spring. It was a significant accomplishment for the firm. We really welcomed a number of new client relationships, and we're really thrilled. It's a significant landmark for the firm. Next month, we'll be opening a new Southeast regional office in Jupiter, Florida. It's part of a key strategic plan to open regional offices in the Northeast, Texas, the Rocky Mountain region, and Southern California. We did not really expect COVID. No one did. But our NextGen OCIO solution that leverages elite technology and external partners has really been optimally positioned for this environment. And we're always looking to add new team members and clients to support the growth of the firm and the strategic plan we have over the next 5 years. So if any of you know somebody that you think would be a good fit for our firm as a new team member, or you think would be a great client for our firm, please have them contact me directly. And the last initiative that we mentioned in our 12/31 webcast is we started an exhaustive search for a new portfolio management and reporting system. We identified initially about 12 candidates. We've cut that list to 3. So a priority for the firm is in the second half of 2021 is to have that new portfolio management and client portal reporting system fully functioning. And we'll be providing more updates about that. But that is kind of the biggest initiative of the firm. So with that, I'm going to turn it over to Nick and Matt to go through the actual 1Q market review and global outlook.
Great, thank you, Kurt. The agenda is going to follow similar as last quarter. We're going to go over a 1Q market review, the global outlook, and then policy allocation updates. For this webinar, we actually solicited questions from our clients, and thank you for all those who sent in those questions. We did receive many questions, and we prepared visuals to address those questions, and they'll be within the presentation as we go along. So looking at the market summary for the first quarter, there was lots of positive news in the first quarter that helped to raise asset values. The reopenings of the economy post-COVID-19 seemed to accelerate. Vaccination numbers are strong, several states removed restrictions, and with the warmer weather, people seem willing to get out of their homes and spend money. We have spoken about pent-up demand and higher saving levels across consumers and corporations. This demand seems to be showing in some of the more recent publicized numbers. Retail sales came out strong this morning, which showed the largest monthly gain since 2020, especially strong in retail and food services. Numbers may have also been boosted by the more than $350 billion in stimulus payments that have gone out since mid-March. A few of us at Global Strategic have traveled in the month of March and were met with full planes, expensive hotel rooms, and limited to no car rentals available. I think it's a personal example of the demand of the consumer as the economy reopens. The Federal Reserve continues to preach their accommodative stance with no end in sight over the near term. This was supportive of equities, which continued their rally in the first quarter, driven again by cyclical sectors, which lagged in the summer of 2020. Bonds had a negative quarter due to the sharp rise in interest rates, especially government and higher duration bonds. Looking at the actual numbers on slide 5, global equities were up 4.6% for the quarter, driven by U.S. small cap stocks and U.S. large cap value. Global equities have now returned over 50% for the trailing 1 year ending March 31st, again driven by U.S. small cap stocks with support from U.S. large and non-U.S. equities. Through today, global equities are up over 8% for the year after a very strong first 15 days of April. Commodities and public real estate also had good returns, and short duration bond markets were down slightly for the quarter with the rise in interest rates. But for our clients who we have a short duration tilt on in our models, so they weren't affected as much as kind of a longer duration bond allocation. The 10-year U.S. Treasury had a significant move, rising almost 1% in the first quarter, and the employment numbers continue to improve, but at a slower rate. On slide 6, we chart out the daily performance moves in stocks and bonds. Even though stocks had a strong quarter, there were significant swings in performance at the end of January and again at the end of February, as investors were concerned that the Federal Reserve would start to unwind their accommodative stance sooner than what was previously expected. Looking at the key sectors of fixed income, high yield bonds returned almost 1%, as government bonds lost over 4%. again, driven by the rise in interest rates. Now I'm going to turn over to Matt Underwood, who's going to cover some more slides looking at what happened in the first quarter.
Thanks, Nick. So one of the key reasons why rate-sensitive bonds underperform so much is because fixed coupon bond prices have an inverse relationship with interest rates. So as rates rise, fixed coupon bond prices go down, especially those with longer dated maturities. The magnitude of the recent movements of the Treasury yield in Q1 represents the second largest increase in the level of rates in the last 20 years. However, rising rates don't have the same impact on equities generally. And as we saw this quarter, equities provided strong performance in a rising rate regime. This intuitively makes sense as rising rates are generally due to acceleration of economic growth expectations and potential inflationary pressures due to that excess capital chasing a fixed number of capital goods. So generally expanding economic growth and money flowing through the system tends to be good for equities. Now we shift to the bottom chart and see that falling rates coincide with negative equity returns. And this is often due to what's called a flight to safety. So sell-offs in broader equity markets cause some investors to seek a safe place for their capital, such as investment-grade fixed income, particularly U.S. Treasuries. Also, decreases in the Fed funds rate during market turmoil allows for the potential of an economic jumpstart in troubled markets to start stabilize things. Now, as we look at all these factors over the course of the quarter on the next slide, coordinated fiscal and monetary stimulus, a reaccelerating economy, and other potential tailwinds for U.S.-based risk assets, we see that come through in the recent strengthening of the dollar over the quarter. The dollar regained some of the ground relative to international currencies, up 4.1% after previously weakening by about 10% since April 2020. Now, on the next slide, we see the coordinated efforts of the Federal Reserve and Congress, as well as the combined efforts of academic and biomedical researchers and pharmaceutical companies, had truncated the length of recovery in what was one of the pronounced drawdowns over the last 30 years. So on this chart, we can compare the COVID-19 drawdown on the right and its recovery and duration when compared to the tech bubble and the global financial crisis. Now, both of those previous examples had multiple years of recovery time and took significantly longer to complete their maximum drawdowns from peak to trough. The COVID-19 drawdown only took 5 months from the previous peak in February to fully recover after a 34% sell-off. Now, since that recovery, markets have continued to this trend with a change in market leadership to sections of the market that have been beaten up significantly in the COVID downturn. So small cap and value names have surged to lead market returns, as we said before. This recovery trade is what we feel is the current regime of the market. And based off our analytics, we feel that the recovery has some legs with monetary and fiscal support and the potential for more government spending in real economy sectors. Now I'm going to take that and hand it back over to Nick to understand where we sit today and what are some of the implications as we look forward through the next leg of the cycle.
Thank you, Matt. So on slide 12, we look at our current forward-looking capital market assumptions. As a reminder, these are 5+ year forward expected returns, and we generate this data based on a combination of our own internal expectations and our strategic investment partners. The green bars on the left look at fixed income markets. Expected returns have dropped slightly quarter over quarter, and investment grade bonds are expected to provide about 1.5% to 2% returns, while high yield bonds are expected to return about 3.2% per year going forward, much lower than what we would have expected historically. In blue, looking at equities, expected returns have increased slightly from last quarter, with the more attractive long-term returns expected to come from non-US equities. And then looking finally on the right side of the chart at the gray bars, these are our private market expectations. These have changed very little quarter over quarter, but they still show attractive premiums relative to their public market equivalents. The red horizontal line looks at our 70-30, 70% equity, 30% fixed income client model. That portfolio is invested in public assets only. The expected return for that portfolio is 5% per year. By adding private markets to an allocation, our research shows that the expected return goes up by about 1 percentage point to 6% return. This is a chart we'll continue to highlight in presentations, as this is our most important and impactful model that drives portfolio allocations. We compare the excess return that we expect from US stocks relative to the risk-free rate of the 10-year US Treasury bond. The chart on the left details the change in the relationship going back the last 25 years. The extremes, which do not occur often, are marked by red and yellow circles on the chart. The red circle reflects when bonds were most attractive relative to stocks during this period, just prior to the tech bubble. From that point forward, bonds beat stocks by almost 7% per year for the next 10 years. Looking at the top of the chart and focusing on the yellow circle, this points to the extreme attractiveness of stocks relative to bonds in March of 2009, at the bottom of the global financial crisis. From that point forward, stocks outperformed bonds by about 13% per year over the next 10 years. Looking at the far right of the chart, we can look at where the signal is today. Today, the signal is pointing to a neutral relationship between stocks and bonds, and as such, we maintain a near policy weight in client accounts. Over history, the signal has spent the most time in this neutral area, and over those times, stocks have outperformed bonds by about 3% per year. On the prior page, we looked at stock versus bond relationship. On slide 14, we compared the attractiveness of different equity regions. The chart on the left shows the trailing price-to-earnings ratio of U.S. and non-U.S. indices. The U.S., which is depicted by the solid blue line, had dropped below its long-term average during the spring of 2020, which you can see on the chart by the dotted blue line, but has increased significantly and is now at its highest level since the tech bubble. Whereas the non-U.S. indices, emerging and non-developed, are more attractively priced relative to their earnings. The U.S. equity valuation is driven by the rise in prices based on the belief that earnings would rise in 2021 and 2022. The consensus growth estimates for 2021 are shown in the chart on the right side of the page. Growth expectations are significant for 2021 across all regions. We maintain a tilt to non-U.S. equities relative to U.S. equities, as we can buy those non-U.S. future earnings at a lower valuation than in U.S. markets. Another potential tailwind for non-U.S. equities comes from the U.S. dollar level relative to non-U.S. currencies. The U.S. dollar has had a strong run up from the mid-2010s and is currently closer to what we would consider an expensive level. Currencies, like all other assets, are impossible to predict in the short term, but the accommodative global monetary policy to restart the economy and the varying economies that have had different reopening dates, Europe is lagging what's happening in the United States, are expected to produce some downward pressure on the U.S. dollar over the long term. Switching focus to fixed income, we looked at the expected return premium from corporate bonds over government bonds. The expected return premium is shown by the solid lines and the long run averages in the dotted lines. Both high yield bonds in blue and investment grade bonds in gray have rallied significantly since the COVID sell-off, and especially since we allocated high yield bonds into client portfolios. Now we're efficiently transforming the high yield exposure. We also refer to it as the opportunistic allocation in client portfolios, with the goal of lowering duration sensitivity, so sensitivity to interest rate moves, while maintaining the same type of credit risk that we get from high yield bonds. I'm going to show you this portfolio on slide 17. So where we can do so efficiently, especially when it comes from tax consequences, we are adding allocations to a floating rate opportunistic bond allocation via an ETF that has a ticker SRLN. There are several reasons behind this shift. First, the top left chart is a sensitivity to interest rates. This top chart on the left looks at the 2013 interest rate rise. Over that time, the instrument we're discussing, SRLN, held up much better than both high yield, which is in red, and the U.S. investment grade aggregate index, which is in gray. Similarly, in 2015, another year where we had a significant rise in interest rates, high yield was able to actually produce a positive return, but SRLN kind of did almost 3 times the amount of return over that period. And then when you compare both of those, especially SRLN, to what core bonds did, a significant outperformance. And this is due to the fact that core bonds tend to have a much higher sensitivity to interest rates. Additionally, if you look at the charts on the left, SRLN is expected to have a higher yield from this point going forward and has almost zero duration due to its floating interest rate mechanics, whereas high yield has a 3.4-year duration, which is a measure of its interest rate sensitivity. Now I'm going to turn it back over to Matt again to go over some of the other forward-looking charts for the quarter.
Great, thanks, Nick. So this is, we're starting to get into a section where several of the questions that we received from clients are focused on inflation. So wanted to make sure that I give the due time to make sure that we cover each of these questions. So When the coronavirus pandemic jolted the economy last year, policymakers responded with unprecedented fiscal and monetary support. So some observers now worry that these historic actions will spark an outbreak of inflation, sending interest rates much higher and potentially derailing the recovery. Based on the key drivers of cyclical inflation, our core macro research partners think inflation will struggle to rise materially higher than that 2% threshold for at least the next several quarters, even the next couple of years. The Federal Reserve uses the personal consumption expenditure deflator, which is shown here on the screen, to gauge inflationary pressures for the economy. If inflation is not sustained over that 2% threshold for a while, and maybe even a bit over 2%, given Fed Chair Powell's comments over the past several months, Fed's not likely to raise rates. One of the main drivers of consumer inflation, the labor market, shows no signs of overheating anytime soon. The global backdrop as well seems very soft as well, with inflation hovering well below 2% in many developed economies. We've listed here on the chart the G7 countries as a proxy for these developed economies. Overall, our outlook for modest consumer inflation supports our positive view of cyclical components of the market that sit in the value and small cap styles, which include significant exposures to financials, industrials, and housing sectors. So on the next slide, we'll take a look at another key driver of cyclical consumer inflation, which is labor market slack. So as we see here in the chart, the labor market has made a significant recovery since the depths of the COVID pandemic. However, the most recent unemployment rate is still almost double the pre-crisis rate, indicating that there's still some meaningful recovery needed before the slack is eliminated from the labor market. Historically speaking, this can actually take a decent amount of time. So on the next slide, we actually see that historical perspective of how long some of these recoveries can be. Generally, spikes in unemployment are abrupt and recoveries are more gradual. However, this spike in unemployment was not driven by layoffs and structural drivers of unemployment due to a decelerating economy, but by the government interceding to shut down the economy due to a worldwide pandemic. So you can sort of think of it as an air pocket. It became a vacuum during the shutdown and was quickly filled as everything rushed in once allowed to reopen. However, furloughs and layoffs occurred, numerous businesses had to shutter their operations, and that rebuilding will take some time. Our research partners that we work with project that we won't start reaching what would be considered full employment until late 2022 or even 2023. Now, although inflation is not likely to rocket to the levels we saw in the 70s and 80s, I think it's even less of a risk that we would suffer from deflation or an inflation rate that hovers around zero. Our expectation is that inflation should be range bound for the next couple of years, while many of the key structural factors that we discussed stay in place. So our base case is that inflation is going to stay relatively low and rise gradually. However, there might be short-term bouts of inflation overshoot, as we call it, even if it's not maintained for an extended period. So it's helpful for us to look at which asset classes perform better or worse in each of these regimes. And the charts on the screen now represent two of the core potential regimes we're looking at from our capital market assumptions. This is the annual performance of these asset classes looking all the way back to 1988. We see that overall, in the currently low and rising inflation regime on the left, fixed income asset classes underperform their long-term averages. Equities still post returns in line with their long-term averages, and emerging markets do significantly better in US inflationary regimes due to the inverse impact of the US dollar strength. Looking on the right-hand side, where levels of inflation are above 2.5% and increasing, the average performance of all assets are higher, especially emerging market equities. This outperformance of growth in this sample over value on a historical basis may actually be an anomaly, as many of these regime years were during the tech bubble run-up. So if inflation is not a huge risk over the near term, that seems good for risk assets, as inflation is not likely to derail the recovery, as many prognosticators have been saying. But actually, in fact, there are some notable tailwinds for risk assets, and we'll cover one on the next slide here. This is the total dollars on the sidelines in money market funds, and that number is near all-time highs. We see the pronounced drive to hold cash equivalents peaked actually in May of 2020, near around $5.2 trillion. And since that time, about 400 billion of that cash has come off the sidelines. Currently sitting at about $4.8 trillion, long-term average is at about 3 trillion over the last 10 years. So this excess liquidity could represent a pent-up demand, which could be injected back into risk assets as the recovery continues. Now, it actually seems likely based off of certain indicators that the recovery will continue. And the next slide, we have a chart representing the leading economic indicators that are followed by the Organization for Economic Cooperation and Development, or the OECD. The current read of these indicators signals that GDP growth in major economies will be above trend. With the supportive nature of coordinated fiscal and monetary stimulus, we could actually see growth rates similar to what we saw in the mid-2000s. Several of our key research partners also see annual growth rates projected between 4 and 7% over the next 3 years. We always like to take these expectations with a grain of salt, but the outcome is that the data is showing strong that the recovery has a stable underpinning.
The last question that we're going to answer in this section relates to Archegos, which I'm sure most of you know, late March, a large family office which was run by a former Tiger Cub had unprecedented losses and a huge loss of wealth in a very short period of time. The question that came in asked, how did the single family office cause such a disturbance? What was the impact to markets, and what will the regulatory response be going forward? So the family office used what is called total return swaps, and it's a very common instrument. It allows an investor to use a significant amount of leverage to gain stock exposures. So the firm used these total return swaps and made the same trade, it seems like, with several different large, big name banks. And the issue is that these other banks didn't really know, it's what we believe now, that Archegos had these same trades on with all the different firms. When this all came to light, these banks had to sell these stocks to meet margin calls, and they all tried to sell these stocks at the same time, which caused a lot of impact to some of these securities. If you can see, Viacom CBS in relation to what it did for the S&P 500 bank sector on the chart, you can see caused a tremendous sell-off to the banks as the banks realized big losses during this time period. Banks were hit with that move. The move was about 10%, and since then they've recovered about 5 percentage points of those losses. And so far this week, earnings have come up for banks, and so far most of the banks are far exceeding expectations. What's going to happen to regulators? We don't really know yet. Regulators are exploring what happened, what could have prevented the banks from taking this type of risk, and ways to respond to the event. It's expected by all that it will be new oversight going forward, and this will improve the current oversight to avoid this type of event reoccurring in the future. Now I'm going to turn it over to Kurt, who's going to discuss some of the active strategic tilts from the first quarter and the second quarter.
Okay, so as Nick and Matt mentioned, within our fixed income, we have maintained purposely a shorter duration tilt in our core investment grade solution that certainly has helped on absolute and relative returns this quarter. For our fiduciary institutional accounts that are participating in this webcast, we cut the high yield allocation in half and replace that with this SRLN floating rate security. We'll be talking about that more in detail in the formal quarterly reviews. And then with the equities, we have a modest overweight to value style within US large cap and a modest overweight to non-US emerging markets based on valuations. Both of those were initiated about 2 quarters ago and have proved to be good moves in the near term. Where appropriate, we have been discussing for the last 2 quarters about investments in 3 categories: private credit, private equity, and private real assets. The vast majority of our clients have implemented these strategies. There's still some we're speaking to about, but most recently, the Variant Alternative Income Fund, which is a daily priced closed-end interval mutual fund, executed. For those of you who are not in it yet, we'll be speaking to you about it. Private equity, we added the AMG Pantheon Co-Investment Fund, which accepts investors on a monthly basis, and the Blackstone Real Estate Fund, also known as BREIT, which we added to client portfolios for the first time in December. And that also is an open vehicle that we can add exposure to at any month. Because we have both taxable and fiduciary institutions for our taxable clients, maybe you recall that last spring, during the recess of COVID, we aggressively did tax loss harvesting. So we have been doing some rebalancing, but most of that we wanted to make sure that we maintained at least a 12-month holding period on those assets. And when we meet with you, we'll talk about our proposed reallocations now that we're in a long-term gain situation for those assets and potentially to utilize these private markets going forward. So with that, I'm going to close the webcast. Once again, we want to thank you for your trust and confidence in our organization. And if there's any specific questions, you can either direct them to me or to Nick or to Matt. We'll follow up, but we'll be scheduling our first quarter reviews with all of you in the very near term. So have a great day. And once again, thanks again for your trust and confidence.